Hey, everybody, welcome to Under the Hood. This is your host, Tim Douglas, and today we have Ethan Ho from Kālā Capital on the show, and we'll be chatting about the three reasons people spend money, the one alternative that can change your life that you didn't think of, and the golden rule of investing. Does that sound good, Ethan?
Sounds good.
Thanks for coming on the show, man. And we like to jump right in, and we always start with your story. So I'd love to hear a bit more about your journey into the financial space, what made you become an advisor, and what brought you to where you are today.
Yeah, absolutely. So I'm originally from Hawaii. Grew up on the island of Oahu, and I have always had an interest in business, investing, money, getting my money to work for me. And so I decided to go to school in New York City after graduating high school to pursue a degree in business. Figuring what better place than the business capital of the world. And so I went to Fordham University in the Bronx, and I was hoping to get a really good understanding of money, investing, how that stuff works. And ultimately, I graduated, and I was still pretty like, this didn't quite do it for me. I don't really have the grasps of finance, investing, and money that I was hoping to have. And so that's what actually got me into the financial services space. I figured what better place to learn than going and working with the institutions and the people who manage money and deal with money on a daily basis. And so that's how I got started. I started working for a national firm as an independent contractor as my first real job out of college, and loved it. Loved helping people figure out their financial game plan. Loved the value that you could add. Ultimately, I found that I felt like the industry was I needed a little bit of a facelift ultimately. And so that's what inspired me to go off and start my own firm, uh, to kind of give the planning, advice, recommendations, and approach to this building up your knowledge base and your skill set to handle money well. I was just craving for someone to give that to me. So I really wanted to create a company that could do that for people who were similar to me, who are in a good income position, who are graduating college or just getting into the working world and was never taught this stuff at home or at school.
Yeah, yeah, no, absolutely. And so that need for a facelift, is that just because, you got kind of bored with the old clientele or who it was serving, or kind of elaborate on that
No,
a bit more?
yeah, so I saw there is a lot of really good people working in the financial service space, but a lot of the companies, in my opinion, were incentivizing those people to make decisions or guide their clients down paths that may not be in their best interest financially. And it ultimately came down to how advisors were compensated. There was just a lot of selling products for a commission or only working with a certain group of people who had a certain amount of investable assets. And so I felt to me like it excluded a huge demographic of our population who may have a really good income, may be very ambitious, may really benefit from quality financial advice, planning, guidance, coaching, but nobody wanted to work with them because they didn't have hundreds of thousands or millions of dollars to invest. And they also didn't want to work with an advisor who is strictly selling, products for a commission, whether it's mutual funds or insurance products. There was just a lot of, hey, we're going to do financial planning for you. We're going to make these recommendations. But ultimately, our recommendations are going to be influenced by how we get compensated. And I felt like there could be a better way of providing transparent, quality advice, especially to people who are just getting started.
Yeah, yeah, I love it. And so, where do you go to kind of stay up to date with latest market trends and financial strategies? You started your career really hungry to learn about that and didn't get enough of it in business school. So, you came to the financial space. Now you have learned it. And so, where do you go to kind of stay up to
Yeah.
date on that?
So I want to, of course, I kind of want to stay up to date with what's happening in the news, what's happening in our economy. And I try to get my information from a lot of different sources, but I really, I think it's contrary to like a lot of popular belief. I don't spend a ton of time focusing on what's happening, what's trending, what's the new thing. I spend a lot of my time thinking about what is going to stay the same. I think a lot of us are looking at like what's the new best hottest investment that's going to generate the highest rate of returns. And I've always felt that chasing returns isn't the thing that's going to make the biggest difference, and that dealing with money and investing has such a huge psychological component. There's so much emotions and behaviors that go into it. So understanding human nature and understanding what about human nature doesn't change. So our psychology behind spending, behind savings, how we react when things, are not going the way we hope they're going in the news, when there's a lot of fear out there, and trying to focus on the big strategies that we believe. So things like asset allocation, things like diversification, and not getting caught up in individual stock picking, what's the newest thing, and that's our approach. That's my approach and my company's approach. Yeah.
Yeah, no, I love that. And so, you're not actually heard that a decent amount from people who are more on the independent financial advisor side of we make a plan, we set up that plan for the client's life, and the plan's supposed to work. Whether it's an up market or a down market, we allocate appropriately.
Yeah, that's exactly right. Because when we start investing, we're long-term investors. At least in my firm and the clients that we work with, we're not working with people with short-term time horizons for the most part, unless there's a short-term goal coming up. But generally speaking, we're long-term investors, and we know when we're investing for the long haul that we are going to face periods of significant short-term loss. We know that we're going to experience one, two, three different recessions. We know that we're going to see rates change. We know all these things are going to happen. Now, do we know exactly what's going to happen? No, but that's where we create investment portfolios. We use balanced strategies. We focus on big investment strategies like asset allocation to create a portfolio that's here to weather the storm, that's here to last, and allows our clients to really focus on what's in their control and not so much about market returns and what's outside of their control.
Gotcha. And so before we jump into that kind of the specifics of portfolio allocation and high level strategy based on market factors, talk to us a bit about looking for what stays the same. You mentioned human psychology, you mentioned how we interact with money. What are you looking at about what stays the same about humans when you're thinking about constructing a financial plan?
Yeah, a lot of it comes down to spending psychology. When we see a lot of fear-based headlines in the news, but then you go out to a restaurant, you go out to the mall, you go out to, an auto dealership, how are people interacting? How are they spending money? A lot of it is conversations with my clients. It's about, their past quarter and how they feel with their plan, with their spending. How do they approach big purchases that are coming up, based on the sentiment that they feel in the market? How do they even approach small purchases on a daily basis? And I think humans haven't changed very much over millions of years, and so focusing on the the soft side of this stuff is where I spend a lot of time thinking and kind of trying to understand a little bit more, knowing that I'm always going to be a work in progress when it comes to understanding this stuff and constantly learning.
Yeah. Yeah. And so when you're looking at spending psychology and understanding where somebody is currently, is that just a lot of conversations with them? Is it having them walk through the more practical sides and then making inferences based on how they talk about their budget, how they talk about their investing, how they talk about help us understand that.
Yeah, so I mean, it's taking all the conversations that I have, and let's say let's just go with an example. Let's say I have three clients at one period of time who seem to come into a windfall of cash, and then talking to them about how they're going to allocate that money. How much are they going to use for spending on wants versus needs? If any are going to needs, how much are they going to be investing for their future, right? What are their concerns? Are they happy around receiving the money? Are they fearful around receiving the money? And you start to realize that everybody has this very different relationship with money, and they have a very different approach. But oftentimes, we can boil down, let's say, spending to a couple of core principles, right? It's people will spend money to make their life a little bit easier, a little bit better, save them some time. Whether that's running water, electricity, AC, something like that, just enhances your life. People will spend money on, I think it's a little bit of a flex, but people will spend money on trying to get somebody else to think of them in a certain way. So instead of driving the Toyota, they're driving the Beamer, right? And is it because the car necessarily does a better job of getting them from point A to point B, or is it because they want people to think of them a certain way when they're getting from point A to point B? And then the other one is sort of some form of escapism, whether it's retail therapy, whether it's drug abuse. But I've boiled down in my experience, like those are the three reasons why people spend money. They spend money to make their life a little bit easier. Uh, they spend money to show people their status, or they spend money to escape their reality. And having a conversation like that with the clients, like, hey, you received a bunch of money, right? How do we want to allocate this? What are your goals? What are your dreams? What do you want to do with it? Gut feeling right away, and then trying to get a little bit deeper. It's like, okay, well, you want to buy that nice new car, but why? What about that is important? And ultimately, my job as the advisor is not to say, hey, don't go and buy that luxury car. Like, if that luxury car isn't about status for you, and you're a car guy and it makes you happy and it lights you up, by all means, but just make a very purposeful, thoughtful decision when doing it. And so that's kind of how I am doing my research, my studying. It's reading, it's listening to people, it's talking to people, and then it's trying to apply it in my world, in my context, because of the privilege that I have of, really chatting to people about their finances, being able to like look behind, the kimono and kind of get a picture of what's going on. Because I mean, I think all advisors can relate to this, that you're so astonished by what you see at face value versus what people actually have. Some of the most successful people that we think are successful, we end up sitting down with them. It's like, you don't really have much to your name. And then on the other side of that, it's like, you don't seem like you would be financially successful. And you look behind the curtains, you're like, you were doing phenomenal, right?
Yeah. Yeah. No, that's really interesting. And I love those three reasons. It was make your life easier, kind of save some time, escapism, or raise your status, which it really boils it down to there are many ways that can come to fruition, if you will. There are many ways to raise your
Yeah.
status, many ways to save time, and many ways to escape. But when you get down to it, those can be the three routes. I can see that for sure. I do want to jump into current markets now. So we've kind of gotten a screenshot of the psychology side of it, and I'm sure that'll be woven throughout the rest of our conversation. But and let me side note here. I know that you don't pay a bunch of attention to the current markets because you do a long term plan. But when you are addressing the market with client, what are the high level factors or the most important factors you pay attention to? And then what's your strategy to address them? Or how do you start building the foundations of that plan?
Yeah. Yeah, so I mean, we look so I mean, what we look at typically is earnings. We want companies that are producing earnings. We think the market follows earnings. We also, look at consumer sentiment, and we look at inflation. Like, we look at some of these core numbers, and ultimately, like, if inflation goes up, it's gonna impact consumer confidence and consumer spending. If consumer spending goes down, it's gonna impact earnings, right? And ultimately, it all comes back to, is the company generating a profit? So with those sort of like key factors, our main focus is asset allocation. Like, how do we spread our money out across the various asset classes in a way that works with your risk tolerance and is in alignment with your time horizon? If we have a young person who's investing for the next 30 or 40, 50 years, like, we are comfortable being, all equities, or very close to all equities. But for people who are a little bit more conservative, have a shorter time horizon, we definitely like to run a globally balanced portfolio. And we're just going to be shifting between some of the major asset classes and the different indices that we're targeting, but we're still maintaining the same overall strategy.
I gotcha. And are you guys more picking specific companies based on their earnings, or do you kind of go not the mutual fund route, but um,
We're
mutual
ETS
funds or
index funds.
indexes? Yep.
Yeah, and we're not picking individual stocks, and we're picking sectors of the market, and we're focusing on that. We just, I think we're humble enough to say we're not smart enough, or anyone is smart enough, in our opinion, to constantly pick the right individual securities time and time again. We already have an overexposure to, like, right now, if we're looking at the S&P 500, whatever the Fab 7 that's going on, like, we have an overexposure to certain companies just by the nature of the indice itself. And so we really want to focus on how much are we allocating as a high level asset allocation view, how much is going to international companies, how much is going to domestic, how much is going to fixed income. And that's where we spend a lot of time. We like to have a little bit of a sounding board when we're making investment decisions. So we have, like, the board of advisors, if you will, who we believe and we like their track record and we share similar philosophies, and we get to have meaningful conversations about once a quarter around, where are we headed and what are the changes that we want to make, if any, to our portfolio to, reflect where we see things are going.
I gotcha. And when you're having that conversation about risk with a client, how is that conversation typically going? Is it established in the first meeting with them, or are you doing it over the first couple months?
Are we talking about risk management in the portfolio, like in asset management, like investing, or just risk management for their entire financial plan?
Let's go both.
So risk management for portfolio, it comes down to it always comes back to asset allocation for us and understanding your time horizon and your risk tolerance. And so that's where we want to lead the conversation, the client through a planning process that helps them self-discover and understand the importance of asset allocation and diversification, and why this is the strategy that, is the buzzword that we talk about all the time, at least in our world. And then we want to lead them through a conversation around their specific goals and when those come to fruition, and then ultimately aligning those two. Uh, as far as risk management goes, like, we have a whole meeting dedicated with my clientele to understanding the importance of having a thoughtful risk management plan, because some of the biggest risks that we all face in our lives are risks that are unavoidable. And so, we're talking about disability, we're talking about something happening that's worse than disability, death, dismemberment, long-term care events. And so understanding the different types of ways that you can transfer risk, right? Because you can either, there's really only four ways to manage risk. You just assume it. You're just like, yep, I'm just gonna eat that risk. uh, you're gonna mitigate it. So you're going to say, instead of driving to the store, because driving is a risk, you're going to walk to the store. You're going to self-insure, which basically just means, like, instead of I'm going to drive to the store because if my car crashes, I have all the funds that I can buy a new car and pay for the damages done. Or you're going to transfer the risk, which is buying insurance. And so we just have that conversation with clients, is like, how do you want to manage this risk? Do you just want to roll the dice with it, gamble it, right? And what are you truly gambling here? What's the price if this risk does come to fruition? Do you want to mitigate it? Do you want to mitigate it through your actions? Do you want to mitigate it through building up your own, ability to sort of self-insure? Or do you want to transfer it by paying a premium and sharing that risk between a group of the people, which is insurance? And so we just want them to make a good, reasonable decision around managing risk, and it comes to their plan, because that's the big thing. One of the big core principles with financial planning, with investment management, is to protect the downside, right? It's way easier to be financially successful if you limit losses. It's like, what are the golden rules of investing? So it's definitely something that we want people to understand. And especially our clientele, they're newer investors. Typically in their 20s to 40s, they're still getting their feet going with what it means to invest. And so understanding that if you put $100,000 to investment and it loses 50%, it needs to make 100% rate of return to get back to $100,000, right? And that makes it more important for you, Mr. Client, to take on risk that's appropriate and not just chase returns. That it's better to get you know a lower rate of return and take on much less risk than a slightly higher rate of return taking on undue risk.
Yeah. Yeah. No, absolutely. Um, I love how you mentioned the rules of risk and risk tolerance. And rule number one, don't lose money. Rule number two, don't forget rule number one. um, a classic Warren quote. And so
Yep.
we understand that kind of portfolio allocation. We understand risk, which ultimately ties back into portfolio allocation. I feel like we also understand how you're going about building these portfolios. Typically, we ask about the actual construction of it, but it sounds like if they're on the younger side, they have a longer time horizon. You're more like, hey, let's do all equities or the majority equities. And if they have that kind of shorter time horizon, maybe they can't introduce as much risk because they don't have the kind of 50 years to play it out necessarily. You might globally balance that portfolio. Does that sound about right, or do you want to add something there?
Yeah, I mean, we usually take a globally balanced approach regardless of the asset allocation, but we'll probably be closer to like a 60-40 split, 40% fixed income, 60% equities, in like a shorter time horizon. And we just look at that because, since 1950, there's like a 99.9% probability, ever since it's like every rolling 5 years since 1950, there's a very, 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 very low probability of having a negative return. So we're like, if you can be invested for at least 5 years, and you're willing to stick out, like globally balanced is a really globally balanced with like a 60-40 split is a very nice way to do it, in our opinion.
Yeah. Yeah, absolutely. I didn't know that about that probability. That's very interesting. Very cool.
Yeah.
Awesome. Well, I do want to jump to alts now, and I know your firm doesn't do a ton of alts, but there was one in particular we talked about discussing before the podcast. You can also say your opinion on other alts as well, but kind of take us through it.
Yeah. So alternative investments isn't something that we put into our portfolio. And typically it's just because our clients aren't in a stage where it might make a lot of sense for them. Oftentimes we're not working with people, it, in my opinion, should have a lot of investable assets to be going down this alternative path. And so for us, we're getting people started. We don't have people with tens or hundreds of millions of dollars that we're investing in. Other If we did, we would probably be considering alternatives a little bit more than what we currently are. But for my clients who are starting, who are in their 20s or 40s, and they want to talk about the exciting side, the alternative side to investing, because it gets preached in social media, we hear about it all the time. um, I will bring up the idea of grabbing people's attention. I think, as Gary Vee puts it, and trading attention is probably one of the most undervalued assets out there. And so it's a something that I wish I understood more when I was starting my career as a business owner, that if you have people's attention, if they know and like you and trust you, no matter what you do in the future, it just opens up the doors for making so much more money. Because we never know what life is going to throw. But if we have a group of people who are taking our message, who actually believe in what we're saying, I think there's so much value there. And it's definitely, when we talk about asset classes or what our clients can do to enhance their situation as financial advisors, I don't think most financial advisors are talking about getting people's attention, whether that's through social media or building an email list or writing a blog or publishing a YouTube video or doing podcasts like this. But I think there's a lot to be said for grabbing people's attention. Yeah.
Yeah, yeah, no, absolutely. And I love it specifically because it really does make sense for everybody. Like the entrepreneur who can grab attention and day trade attention, if you will. Has that book come out yet, or is it in the process
I
of
think it's
coming
in the
out?
process of coming out.
I got
Yeah.
you. I'm excited for that one. I'm excited for that
Yeah.
one. But obviously, entrepreneurs who can day trade attention, that's basically advertising and marketing, which will help fill the top of your sales funnel, which will ultimately lead to sales. And if you treat your sales right, it will lead to customer relationships that lead to referrals. So your business grows as an entrepreneur by day trading attention. If you have a career and you can day trade attention, you might be able to land gigs that you couldn't have before. Like there are plenty of, I think of the Papa John's employee who goes viral making pizza. I'm like, he is making so much more. His income has increased so much compared to the regular Papa John's employee because he can capture that attention and give it to Papa John's. I'm sure he has all types of sponsorships and he's making more than minimum wage or whatever you would at Papa John's. And then even for the retiree, if you can like day trade attention in a more focused manner, right? Like maybe you're not trying to get millions of followers to a blog necessarily, like the kind of social media gurus are preaching, but maybe you're trying to get in with one or two communities that give you access to the exclusive opportunities that you might not have otherwise. Like still being able to grab that attention is key as well. And so I think something when you talk about attention that can get misinterpreted is that it always has to be on Instagram posting reels. It's like, no, not necessarily. It's like, how can you get the attention of the people you need to do the thing that you want to do? And that's why I think that's such a powerful and underrated topic.
Yeah, and I would like to add for retirees, we primarily don't work with retirees, but we do have our handful of retirees, and I have worked with retirees in the past. And I am all about creating a financial plan in life that makes you the most happy. And I have found that the retirees that are generally the most happy, the most like loving of life are in a phase of their life where they're sharing. They're sharing what they've learned with the next generation. And that can be in, church or community groups, that can be through nonprofits, that could just be through your network. But that brings us back to, attention. Like if you have a good message to share, but you have no attention and nobody to share it with, like it lands soft or flops, the message flops. And so if you have that attention, and you can, find a way to share your life story, like I would be appreciative. Like I want to hear from all the people who've been through it and done it before, what worked, what didn't work. And I think that's a way that grabbing attention as an alternative, air quote here, alternative investment could really work for someone who is in that retiree stage.
Yeah, for sure. And I mean, we put the air quotes around alternative investment, but it is something that you can invest both time and capital into. So
Hmm.
it's
True.
a very real thing that you
Maybe
can
drop the air
allocate
quotes.
towards. Yeah, yeah. No, absolutely. Well, cool. Is there anything else that you want to touch on in the alternative space, or do you want to kind of move to the next section of the show?
No, we can move to the next section.
Perfect. Well, we always like to wrap it up with, just hearing a bit more about your firm. We start with it in the beginning and then we jump through the market and alts. And I would love to hear a bit more about what you feel really separates you from other financial advisors.
Yeah, so I think this is something that I'm constantly iterating on as the business owner and trying to make sure that we are adding value to our clients' lives. And so, as it stands right now, I think that we're very different in the sense that we want to do what every good financial planner or advisor does, which is come up with a roadmap, a plan of action. We always call it a clear, simple, and automated plan. It needs to be something that you understand. There needs to be clarity around the plan, which means not only understanding where you're going, but also understanding where do you stand financially? Are you on the right track? Right? A lot of times that level of clarity for most people I speak with isn't there. They don't understand the role money plays in their life. They don't understand their emotions around money. It's just sort of something that just is, and it has been, and they don't reflect and dive deeper into it. Uh, so we want to help them build that clarity of not just what your investment portfolio looks like, but why it looks like this. What are the different accounts that you're using? Where do you stand right now? And are you on the right track? And that's something that always needs to be reviewed and I think reassessed. I think the plan needs to be very simple. It needs to be something that you can sit down and explain to your spouse who may not be as interested in money as you are. Maybe you need to explain it to your accountant, your kids, something that you can actually share and communicate maybe over a drink with your friend. Because if you can't understand it, you're just simply not going to stick to it. And then we need to automate the plan because humans are super emotional and the decisions we make um, are not always logical. And so if we can take away the time, energy, bandwidth of having to make financial decisions over and over and over again and just automate what we know is going to work that sticks to the long-term plan, that's going to be the ultimate, like the one thing that I could tell everybody if they want to be financially successful over a long haul, they need to have a clear, simple, and automated plan that aligns with their mission, their values, and actually moves them closer to where they want to go. And they need to define where they want to go and where they're at. I think every financial advisor should do that. And that's kind of like, okay, this is the normal stuff. I think what makes us different is that we walk people through a very defined planning process that is intensive in the first 12 months of working with us. And then we give them the options. Like, do you want to take this and run with it on your own so you don't have to pay a financial advisor or hundreds of thousands of dollars or thousands of dollars over the year, maybe potentially hundreds of thousands over your lifetime, and you want to do this on your own to mitigate the fees associated with it? We give them that option. So like our first 12-month planning process looks like us meeting 6 to 12 different times with our clients. It's us assigning educational videos and worksheets that we've created in-house so that they can build up their knowledge base, their understanding, their clarity to a point where they feel confident in what they're doing. I've found that I don't have the time to sit down and educate every single one of our clients at the level that I would like to. We don't have the time to talk about every aspect of financial planning, but we have time to talk about what's most important to them. So throughout our our company's career, we're creating virtual assets, their videos, their worksheets, their case studies, their questionnaires that lead people through a planning process to help them self-discover, to help them reflect, to help them build upon the education. And we couple that, which is like the soft side of financial planning, with the actual math number side of things, and saying, hey, this is your plan of action, this is your statistical probability of success, these are the variables that we're taking into account. And then that combined creates the best chances that of the client having desirable outcomes. And that's what we're here to do. Right? We just want to make sure that you're making decisions and implementing things that are increasing your probability of success based on what's important to you. So that's how we're a little bit different. And then we, of course, we work with 20s to 40 years old. So you don't have to have tons of assets to work with us. And we're not out here just trying to sell certain products for a commission so we can get paid.
Yeah, no, absolutely. That's actually a huge difference. I really like that kind of 12-month mark. We're gonna be intense. One meeting every 2 months or one meeting a month, depending on who the client is and what they uh, want to go with. And then after that, we're gonna say, hey, do you want to pay a financial advisor for the rest of your life? You have a plan. It's pretty solid. It's automated. It's aligned with your emotion and mental side of money. So
Yeah, your
here's the
money mindset.
choice.
Exactly.
Yeah, your money mindset. I like that a lot. Were you about to say something else?
No, I mean that you pretty much summed it up perfectly. And at that 12 months mark, we want people to feel confident enough to do it on their own. We also understand that it's a lot like fitness, where we know what we should do, we know how to do it. Does that mean we actually do it? And so for a lot of the people who continue to work with us in year 2, 3, 4, and 5 and on, it's because they understand the accountability, the coaching, and the value that that side of this business brings to the table.
Yeah. No, I love that. I love that analogy because there are plenty of people listening that were supposed to hit the gym today and did not
Yep.
go. So uh, there we go. Well, Ethan, last question for you. What do you think is most important to that ideal client advisor relationship?
Trust and competency, right? You need to trust your advisor. And for the advisor to build and gain your trust, you need to be good at what you do. So, trust and competency are like the most important things. And that ultimately comes down to the advisor being honest and looking out for the client's best interest and being really good at communicating and sharing the complex stuff that we do, behind the scenes for a lot of our clients in a way that they can keep it clear and simple. And so that they can understand it, so they can take the action against the recommendations that's going to make the biggest difference.
Yeah. Yeah, absolutely. Well, Ethan, for people listening to this, if they want to find out more about you, where should they go?
So you can either go to our website, clawcapitalpartners.com, or you can, follow me on social media. Ethan the Money Man Ho is my personal Instagram, but I do share a lot of financial planning tips and tricks and mindset things on there. So those probably be the two best places to start. And then you can find all of our other, blogs and our small YouTube channel and all that stuff from one of those resources.
Perfect. Perfect. Well, guys, thank you so much for watching. Ethan, thank you for coming on the show. All the ways to contact Ethan will be down in the show notes, and we'll see everybody on the next one.
Thank you, everybody. That was awesome.